But Don Kim says, definitely important. Could you offer insights on options for individuals needing to move but stuck because of not wanting to trade a 2% interest for a 6% interest, asking for a friend? So essentially, what Dong is mentioning here is, well, say I'm somebody who bought in honestly just like 2020, right? 2021. And I was able to lock in a 2% interest rate. Ooh, 2% interest rate on a home loan of whatever, your loan amount is, $500,000, something like that. And one of the biggest issues right now with real estate is like very, very little demand, for sure. At least I'm in South Carolina. I know Tennessee, some other states as well. Demand shrinking a little bit. Some are still going up, which is fine, but it's partly two reasons. Interest rates are so high, so buyers don't want to foot the bill. It's harder to get approved for a home loan because of interest rates being so high. But then on top of that, what are you going to do if you try to sell your house? If you have to sell your house, and maybe if you're upgrading or if you don't own your house outright, like you don't have cash, you're going to have to sell your house and then take a new loan out on a new house, which would end up being 6 or 7%. Right now, current rates, depending on your lender, is right around 7.5% for like conventional, as far as a couple weeks ago that I saw an update on it, and around 6.5 for FHA. Again, depending on your lender and some incentives that you can get along the way. So I guess what you're asking is like, yeah, why, or should I actually sell my house? Hopefully take some proceeds and buy a new house at the 6% rate. And I guess there's a few reasons why you would do that. One is like maybe your area, is going downhill. Maybe crime's going up in your area, and you're like, I don't want to be here. I actually had a call with a guy recently, in California. It was like, should I sell my house or what have you? It's like, up? Are people moving away from your particular town or city? These are good reasons to think like, oh, if everything's going downhill, if less people are moving to the area or more crime is coming in, the value of your house is going to drastically, I would say, decline depending on how severe it is, and then also make things harder and harder to sell, especially when I take clients around to different neighborhoods. You can feel the difference in reaction if you see like, I don't know, a truck on a lawn or something like, I don't know, like little things like that. You see a fence broken, or things a little bit broken down in particular areas. So you for sure, can have those different feelings for those particular things. So that's maybe one reason why you would do it, and you would foot that bill of that extra 4%. I would definitely say, as far as like options are concerned, that I would say that it's tough to say because, well, it depends on your situation. Let's just assume that you have a house that's not fully paid for, and you're just a normal person, put down 5-10%, have a little bit of proceeds, but you're essentially taking out a whole new loan for a home at 6 or 7%. Now, I guess a couple of things to note. One, on the interest rate side, is you have to know what's available to you. You'd be surprised. A lot of people have bought homes before, but they still aren't fully aware of the process and ways to kind of like game this. Kind of like how our credit card people do, right? We kind of game the system, get the welcome offers. There's welcome offers for particular lenders as well. Specifically, if I go down the list a little bit, a lot of local lenders, if you talk, not like the Chases or what have you, it's like these, I don't know, just particular banks that are in the area. You can go and talk to the lenders in there. And I've done this. I've sat down with millions of them. So I kind of know what they offer and what the differences are. Some of them actually have ways to get a lower rate just by being a customer with them or being a first time customer. Essentially a welcome offer. I know one in particular here in South Carolina. They literally said, like, if you just open up a checking account with us, we'll drop your interest rate by like 0.25%. So instead of 6, we'll give you 5.75, which seems like nothing, but obviously amortized over the course of 30 years could save you money, and not even factoring in refinances and stuff like that. So little things like that. There's also there's some like, I would say outside of like actually lowering the rate, there's ways to get incentives in different ways. Like, for example, there are some lenders out here that have different loan types. Like, let's say, again, I'm speaking from experience in South Carolina. I don't know how it is in some of your other states, but USDA loans, they're fairly uncommon. I've dealt with them a good amount, oddly enough. But USDA loans are interesting because, sometimes they'll offer basically loan options similar to that of like VA loans. If you guys aren't familiar, veterans, you can get VA loans, which is like 0% down. So like that example earlier of like 15K, you have to put down payment. You could put zero down, zero money down, and then you just pay closing costs. there are ways to get rid of what's called PMI, which is if you put less than 20% down on a house, you'll, in most cases, you'll have to pay what's called private mortgage insurance, which is, I don't know, call it 300K house, call it an extra $200 a month or something, like $250 a month. That could be waived under those particular loans. There's also like not even USDA, but just specific loans with particular banks that they get, I guess, affiliates with others, where you can again get like those zero money down, no PMI, much better rate, what have you. Some other ones that some people have mentioned on Credit Card YouTube is Navy Federal. You guys are somewhat familiar with Navy Federal. They have some actually very interesting loan options, ones that are similar like the ones I mentioned, no PMI, down payment, whatever. But there's also an option. Here's something, Don Kim, that I think would be good for you or for your friend. Navy Federal, and I think there's some other ones, but I couldn't tell you off the top of my head. But Navy Federal, I know for sure, has this program where I believe it's somewhat income capped. You'd have to look at your state. But if you can get approved for this particular loan with Navy Federal, you actually, if you're in the house for 6 months or longer, so 6, 7 months, whatever, years, as long as you make it 6 months, and then after that, you can actually refinance your house for like a one-time fee. It's like, what was it, like $150 or something like that. Whereas normally, if you were to refinance, and I'll tie it into the interest rates, let's say, for example, we're at 6.5% right now. 2 years from now, we're at 4.5%. Wow, it dropped 2%. How do we do that? Under this Navy Federal program, should you have access to it, you can, or sorry, if you don't have that program, just a normal loan, you would refinance your house like, oh, I'm getting a good rate, right? 4.5%. But no one tells you that you actually would have to when you refinance, you'll have to repay those closing costs. So again, 300K house example, another $6,000 in closing costs. So again, out of your pocket, you have to pay 6 grand, possibly even a little more depending on fees and depending who you go with. But most of the time you'll have to pay another additional set of closing costs because you're basically you're rebuying a new loan essentially with the lender. So they pay off the old one, you get a new one, and you repay those closing costs. But with Navy Federal, with that particular program, they'll actually waive that, and you only pay like a one-time fee of $150. So not only could you refinance at the lower rate and get 2% less or 3% less, depending when you actually go to refinance, years from now, you don't have to foot the bill of those closing costs again. So I think that's pretty powerful. So I would say, I guess, three prongs. So the first one in your case, for your friend, one is try to get incentives from the lender itself. See if there's any programs. I'll open up a checking account. We'll lower the interest rate. Or do you have any incentives for me to go with your program versus others? Shopping around. Two is some of these programs. I'm telling you, it's not just Navy Federal. I know there's other ones. But look around if you can in your city or your state or whatever. But like those Navy Federal programs where you can refinance at and really basically no cost, like those extra couple percent on closing costs. I think that's powerful. And this way, maybe you'd be stuck at 6.5 or 7% right now, but it's temporary. If you can deal with the payments right now, and if you believe in the economy and you believe that interest rates will come down maybe a little bit, at least like 5%, something like that. Maybe they stay here forever, who knows? But if you do believe things will go down, you could always refinance in the future, 5, 10 years down the line. Who knows when it would be, but you could always refinance and not have to foot that bill. I guess the main thing is assume that the 6% will last forever. I think as Xavier actually mentioned there, he mentioned what did he say? Date the rate or marry the rate. Assume it's going to last for a long time, but much like dating, sometimes they don't last a long time. You never know, and maybe the rates drop and then you refinance. Or in my case, I thought I was getting a bad rate at 6.6%. I thought it was bad conventional. Come to find out, I tried to do that same loan today at 7.6%. I was like, whoa, I saved a percent. So it's like basically viewing it on a timeline of like, okay, a bad loan, now it's good loan. And then later on, it'll be a bad loan again of a rate. And I guess the third prong is something I've been mentioning more and more often. Some people disagree, but I just feel like there's so much money out there right now to be had from buyers in two different ways. So like since competition's so low right now, I'm finding that a lot of sellers are just being very open and generous with getting closing costs. For example, there's one house that I'm in contract with right now, probably closing not too long in the future, but it's under contract. And we were able to negotiate on what would normally be someone has, let's just say for an example, I won't give exact numbers, but let's just say for an example, I had to, if I'm a buyer on this particular house, we had to pay down payment, closing costs. Let's call it $20,000. Um, but because times are kind of tough, and we got into the deal with a good offer, and we know the market right now here in South Carolina, I was able to eventually end up negotiate about $8,000 off that $20,000 spread, via what I mentioned earlier, like repairs, like getting basically repair costs paid to us by the seller, and they're also paying my fee, so that's cool too. So going from a $20,000 fee down to like $12,000, something like that. It's only 12K out of pocket instead of 20K, just because of right now with competition, you can kind of ask for a lot, and that's what part of having a decent realtor is. Just like, or do they know what to ask for or how to ask for these particular things? Do they know how to talk to the seller agent, I guess a little bit persuasive in a way. um do you have the right inspectors to get the job done? So this way, you want an inspector that's going to point out everything as a buyer, right? As a seller, you want the inspector to point out nothing. And as a buyer, you want the inspector to say everything's wrong with the house. So this way you get the most money. So that's where you can save some money. So I would say the third prong is having a good realtor, not as much competition now. So you can get some more money on the back end in your pocket as a buyer. I think that's powerful. And then I guess I'll still mention it because I think it's powerful. I still think new construction is good. Some people, and look, I've dealt with them in person in real life. They mention like build quality and some issues like that. And you'll kind of, if you have a realtor who's in your market, they kind of know which builders uh, have more often complaints when after they buy the house. Because as a realtor, you get the calls every now and again. They buy the house, but then they every now and again you stay in touch, and they'll say like, oh. I'll just say a random one, no shade to them, but like Ryan's Homes here in South Carolina, they'll be like, oh, their build quality is not good. Like they always have too many settling cracks. Like there's always settling crack, but there's too many settling cracks, or the build quality is not right. So I don't know. I've worked for a builder directly. I've worked with the inspectors there. I've done inspections with them. Like uh, on average, yeah, I think there are scummy builders, and there's ones that cut corners and they absolutely try to get the build done as fast as possible, because the faster they build a house and get you in it, the more they get paid. So there's a lot of issues that can come wrong when you're doing things fast. But a lot of these builders got really proficient in building some of these houses, where some of them still get built fast, but some of these the companies are really reputable and they never have issues with their homes. So I think a lot of it is knowing your market, because the same builder could be good in one market and not in the other, because it's different managers, different team. So it's good to ask your agent around what is he heard about these new construction. But why I bring that up is, again, the competition is not there. Like it's just not there. So like I'm showing some buyer like, look, you don't have to do this, but if you have an idea to not only just, and this is not only just building a house, this could be a pre-made house, one that's already done just in a new construction community that's not finished yet. They're offering in some cases upwards to $20,000 in closing costs to you just by buying the house, just to get a buyer in there. What I always like to tell clients is like, new builders are like they are. Nobody gets paid unless you buy a house. Like the agents that are working there, the builders who are the workers who are actually there, and the builders behind the scenes who are funding the whole operation. Like nobody gets paid until you buy the house. So they're like, and their margins are not great, but they're decent enough to like throw you some cash. So they have what's called flex cash on a lot of them. One particular neighborhood I'm familiar with, they're like 300K houses. So in our same example, call it 5% down payment, 2% closing costs. So about 20 grand. So 20 grand, you have to buy this new build. But they're actually offering what's called like flex cash of $10,000. So that 10,000 can be used towards paying the full closing costs off. So that 6K is wiped away. No, it's keep it in your bank account. And then the extra 4K, they'll actually allow you to put towards what's called buying your rate down, which some people aren't familiar with it. Basically, all it is you say, hey, I have 4 grand that I can't use for anything else. Lender that I'm using for this particular builder, can you take this 4K and buy my rate down, which lets you go from, let's say, it depends on the rates at that particular time, but say it's a 6% rate, maybe you give them 4K, they could drop it to 5.7 or 5.6, something like that. Like I said, it varies by lender, but I mean, that's powerful. That's another way to get your interest rate possibly lower. And also sometimes these builders will offer something like for 3 years, we'll offer you a 3%. So you can still get like your 3% loan that people got many years ago for the next 3 years. And then hopefully, in 3 years, rates come down and you can refinance and have that stable for across 30 years. So it's always good to walk in there, ask them like, okay, what are the deals with your builder? And I would suggest go to all of them, talk to all of them because they all have something different. Okay, 10K flex cash, and you can give me 3% rate for 3 years, or no cash whatsoever, but you give me a 5% rate. There's one that we went to not long ago, 5% rate for 30 years. It was for 30 years, but they didn't offer any cash whatsoever. It was just to get people in the door. So I'm just saying that it's just, you need to know what's out there. You need to know what's possible, and then just go. You don't even need an agent to go there. You don't even need to go. I mean, I would say tell your agent, because there's a way that sometimes, if you have buyers, like if you want, okay, I'll just say you can go yourself. You don't need an agent to go to these new construction communities. But should you go to buy a house, I would say always add in your agent's name so they can get paid. Even if they didn't anything, it just helps someone out because it doesn't cost you anything extra, and it does cost the builder extra. But you're not paying extra as the buyer, but then your agent gets paid. So I don't know. I just think it's important. But yeah, I just think that you have to know what's available and just go out there and talk to people, talk to the lenders, talk to the new builders, and get yourself out there.